Thank you, Ms. Sharma, for taking our time to speak to us on this very special edition of the interview again. So it's been almost a year since we last interviewed you, and sentiment has taken a complete U-turn since then. There's a lot of hope going around. So I'd just like to start by asking about whether you think that we're really past the bend in terms of issues on the economy. Do you think that there are better days coming ahead from now?
So I think Aniruddha, there are two remarkable things that are special about this mandate. One, of course, everybody has written about the fact that after 3 decades we have a situation where a single party has majority in parliament, so has the ability and the authority to drive through policy decisions. To me, actually, what is equally if not more important is that we have seen a campaign which was run for over 6 months, and a very consistent campaign in terms of the messaging, which was focused on development. So there was very little talk of religion, caste, any of the or doles. It was really about aspiration and development, and I think that's a very defining issue as far as this particular mandate is concerned.
Definitely, and you've actually been part of a few meetings at New Delhi with the new management, with the new regime change, so to speak. So, what's the kind of sense you get from that? Do you really think that things have started moving in a much faster pace than before?
I think it's too early to judge. I mean, it's only a couple of weeks into the new government, but clearly what one can see is clarity of goals, clear focus, the willingness to listen, and the willingness to try and find solutions which will be right for our future. I think that speaks for a lot. And if you just look at the energy level of everybody who wants to try and find a solution, I think it means a lot. I've been involved in setting up various businesses, Aniruddha, over the years, and every time I've started off by saying, let's get together as a team and have a vision of where we want to go. And when you set the vision, it's based on broad themes and goals and what you see happening in the environment. Once you have an aligned vision, then I think it becomes much easier to get to the goal. Most often, we have, whenever I've started out those businesses, we have not known the path that we are going to take to achieve those goals in precision. You have a broad set of goals which have been thought through for internal consistency, but the exact path you have to evolve as you go along, especially in a fast changing world, you will discover the path as you go along. So I think what is remarkable and what can be seen in all the meetings and interactions and the interviews that you're seeing the new government do to the media. Frankly, I've heard more about what the government is thinking from the media than directly, but there is a consistency, and there is a consistency of thinking and a consistency of what is being said over a period of time and across different leaders. I think that is very important to actually achieving your goal.
So that's another thing that we've seen in terms of investment sentiment also. So the markets, for one, are clearly zooming up to new highs almost every day. So I just want to understand from you, do you believe that things are going to get better in terms of the market sentiment, or do you think that this is an initial euphoric kind of reaction which may just die down going forward?
So as I said, according to me, I think sentiment means a lot, because if you have belief, then you can make a lot of things happen. And markets will always be ahead of the reality, right? The markets will discount the reality by 12 to 18 months depending upon general risk appetite across the world. So I don't think the markets are going to say that your GDP is going to become 7% tomorrow. The markets are saying that we now see a growth path going forwards, and we expect that the situation is going to look very different 12 to 18 months from now. And I think we have reason to believe that that will be the case.
So the government now really needs to start, moving in terms of keeping this momentum going. So, just to start with, what do you think could be the first few moves which one could take to ensure that this momentum stays on track from here?
So, the problems that we are all grappling with are well known, as I said. We have our fiscal deficit situation, we have the current account deficit situation. To be fair, I think there's been a lot of improvement on both of those counts over the last year, and we are at a reasonable place right now. So I think keeping it at that level or slightly improving from there is a good path to take. But we also have problems on LOGJAM projects, which billions of dollars of investments have been put on the ground, and that investment is not productive because it may have got stuck at a particular approval point, or the project has come up but the raw material is not there, or the offtake is not there. I think we have to unlog this jam, because the investment that has been made, whether it be by the promoters or the financiers, needs to be made productive for the next round of investment to come in. So that's one big problem that needs to get sorted for. The other problem is the log jamming of the payments infrastructure. So payments are stuck to EPC contractors, they in turn don't pay their vendors, so the whole working capital cycle has got bloated. And for a capital short economy, we have to get that down. We have to get the working capital cycle to become a lot more efficient. So I think these are two big themes. As far as global sentiment and investment climate is concerned, we need to reduce the level of uncertainty. So we have to have transparency in the new allocations that we do, and we need to have some kind of certainty given to developers and financiers that if a decision was taken in a particular policy regime, then that decision is going to hold for the next 10 years, 15 years. If we have to invest in infrastructure and capital intensive projects, then these decisions need to be long term. So I think we need stability of that policy regime. That is critical for us to really kickstart the investment cycle. So if I had to prioritize, I would say, unlock the currently stuck up projects, get the payment cycle to start again, and then focus on getting the investment climate sorted out for further investments by reducing the level of uncertainty associated with investments. The other thing we'd love to see in the budget is some initiatives to encourage long-term savings, because over the last 7-8 years, the other trend that we've seen is savings moving away from financial assets to physical assets, and savings not going into long-term instruments like insurance or pensions or even long-term mutual funds, which can provide funding for long-term investments, either by way of equity or debt. So some incentivization of long-term savings to help create the right markets for this investment would be welcome.
So that actually brings me to my next question, which is in terms of the budget. Of course, it's around the corner and there's a lot of hope. There's also a little bit of apprehension given the recent statement from the Prime Minister saying that he might need to administer some kind of bitter medicine as far as bringing the economy back on track is concerned. Are you a little wary of what that bitter medicine could be, and what are your hopes otherwise from the budget as such?
When you have to get out of a problem, you have to take the hard calls, right? Otherwise, you're not going to move ahead. So and I think all of us should feel comforted from the fact that the government is willing to take the tough calls where needed. And I think what we would like to see in terms of direction is we should stay with fiscal prudence. So we shouldn't increase the fiscal deficit relative to last year. We may not target what was there in the interim budget, but somewhere in between would be a good place to get to. I think we want on the expenditure side that money is used for productive purposes rather than dole outs or consumption. So some rationalization of subsidies and using the various programs to create assets on the ground, that I think would be a very welcome step. As I said, encouragement of long-term savings. I think those are the things one would expect to see in the budget, and I'm sure there will be a lot of policy announcements before and after the budget which will move along in improving the whole investment.
There's a lot of talk about tax reforms also. GST is something that a lot of people have been talking about. Yeah. Is that something that you think there could be some kind of moves on?
So I think GST, everybody is waiting and hoping will happen. Whether it can happen in this budget, I don't know. It may be too early, but clearly some movement in that direction would I think help simplify doing business and removing some of the bottlenecks to logistics and goods movement. I think definitely it will help as far as GDP is concerned. But as I said, I don't know whether it can happen in this budget. I think it may need a bit more debate.
And also in terms of financial sector reforms, though a lot of it of course has to do with public sector banks and PSU entities, but do you think that there could be something done for the finance sector as such, apart from what you mentioned already in terms of encouraging small savings?
As I said, some tax incentives for small savings will help. Two, depending upon what are now the most important goals of development for the country, I think we should look at what are the preemptions on the banking sector, whether by way of SLR, CRR or priority sector. Are those aligned to the goals of the future is something that's worth debating and talking about. And I think RBI has looked at what is the adequate level of capital for the banking system. I think we need to calibrate that depending upon the balance between growth and risk. So, depending upon the portfolio of businesses that a particular bank is doing, we need to look at what's the right level of capital. Is there some other kind of capital instruments in addition to tier 1 that we can look at, and how will we grow those? I think those are all issues around making sure that banks have adequate capital for growth. And I think the other thing that as banks we'd like to see is you need a strong credit culture for banks to be ready to take risk. So, one, you need reduction in uncertainty through more stability of policy, but two, you need a strong credit culture where banks are willing to go along and take risk, provided we know that if there is a defaulter, that there can be quick and effective action to recover dues of banks. So, I know that there are the DRTs and SARFAESIs, but moves which will help faster execution on some of those would, I think, help the banking and financial system.
Yeah, that's kind of a demand from the entire sector in terms of revamping this whole SARFAESI and DRT route. Of course, that's something that will probably take some time. But also, just moving away from the entire sentiment issue, in terms of the macroeconomy and the inflation trends, not much has really changed on that front. In fact, the recent WPI figures also seem to have inched up. Just want to understand what are the concerns on that front, and therefore, where will inflation be heading from here on?
So, you've heard me say this before, I guess, Aniruddha, that I think we have to find solutions which are flexible enough to deal with the problem. If a lot of our inflation is coming from supply side issues and is coming from some macro policy themes that we are choosing to pursue around, for instance, reducing fuel subsidy and therefore the increase in fuel prices and the knock-on increase in inflation, then I think monetary policy has to take that into account and move ahead in terms of what we target. It has to be a flexible policy which focuses on both growth and inflation. What you clearly want to see is fiscal prudence. So, I think if we saw that the fiscal deficit was being managed well, if expenditure was going towards removing supply chain bottlenecks, if there was some other action being happening in the fiscal space which is going to manage prices of food, for instance, then I think you feel more comfortable letting monetary policy ease a little bit. But ultimately we have to recognize that how do we get out of this logjam? You're going to get out of this logjam by taking some measures on the fiscal side and some measures on the money side to make sure that people are willing to put in that money on investing. If our cost of capital is very high and there is uncertainty, then you are not going to put in the money on the supply side to create the capacity, and you won't get out of this cycle. So, my view on interest rates has always been that you have to have a bit of a balanced policy regime here which focuses on both the growth and the inflation agenda.
So, we saw somewhat of a dovish tone coming from the RBI in the recent policy statement, but despite that, do you think that he'll probably be forced to keep interest rates at these levels for quite some time, at least the better part of this year, to ensure that inflation doesn't go out of hand from here on?
So, Aniruddha, I would just repeat what I just said, that I think RBI will look at a lot of parameters when they think about what to do on interest rates. I am sure they are going to look at what is happening on the domestic policy front, what is happening in terms of the initiatives that the government takes on the supply side. They will have to be conscious of what is happening in the global markets as well, because today we are in a very connected world and flows impact us in many different ways. So, action in Iraq changes a lot of things, and without that one might have felt that the chances of a rate reduction were better. With what's going on in Iraq, maybe chances are going to be a little tougher. So you'll have to look at global indicators, you'll have to look at what's happening on domestic policy, and then I guess RBI will have to take a balanced view on where to go in terms of the growth versus inflation versus financial stability situation.
So are you worried about the goings on in Iraq and in the Middle East, given the kind of effect that it could have on the Indian economy?
I think it's definitely a problem, and hopefully it gets resolved and contained sooner. But otherwise, given our dependence on oil right now, it has a direct impact on oil prices and knock-on impact on other commodity prices as well. So definitely it's a problem from an inflation perspective and from a CAT perspective.
True. So just keeping it with regulation and RBI related issues, you mentioned a while back that there are issues in terms of kind of finding out what the prescribed level for SLR and CRR should be, how we should bring it in terms of the international levels. Now the RBI has already lowered the SLR once and said that they might look at bringing it down if government finances come back on track. They've also introduced the LCR for you. There are a whole host of other capital requirements which will start coming in. So how are banks like yours kind of bracing yourselves for this, and you actually hope that things like the SLR and all would possibly get even more internationally aligned going forward?
I think the reduction in SLR was a welcome step, and to be honest, not expected this early. So we were all hoping that it will come down over a period of time, but I think the reduction in the last monetary policy was clearly a unexpected but welcome step, which allows more resources to go towards investment in the private space, and I think that's good directionally. The pace of how we can do this is obviously going to be dependent upon how other capital markets in the system grow and what's the level of funding required by the government. But yes, it will be good to see SLR come down over a period of time. It will be good to see CRR come down as well a little. On the liquidity ratio, I think it's pretty much in line with global practice, and for us as a bank, I think we are good with it. We have focused on building a strong funding position, a stable funding franchise. So I think we are well positioned for that. Even on the capital side, we have been planning capital for a while, and we have always wanted to maintain a core tier 1 ratio of 9% plus. So I think we are well positioned from a capital perspective as well. But for the banking system as a whole, I think there may be steps that the banking system needs to take to gear up for both of these events.
So now moving on to a few questions on the bank as such. We've spoken about the sentiment and how the change in sentiment has changed a lot of things as far as the economy is concerned. How does that change things for Axis Bank? Will that change your business plans in any way? Will you be looking at more aggressive corporate lending at this point of time?
See, from a strategy perspective, we haven't changed our strategy at all. I think strategy needs to hold through cycles, and our strategy has been to build a balanced business and a customer led business. So we intend to be primarily a domestic bank focused on both retail customers and corporate customers, and be able to offer a full suite of offerings to this set of customers. Those are our strategic goals, which span across cycles, as I said. As far as will we grow corporate lending, I think the last 18 months there hasn't been much happening on the investment cycle. So there haven't been many opportunities for corporate lending. And in addition, of course, we were expanding our product portfolio to retail customers, which saw us doing above normal rates of growth on retail credit. We still don't have a fully penetrated offering to retail customers. So I think retail lending will continue for us to grow faster than what we would expect in a more normalized scenario. But if the investment cycle comes back, I think it's fair to expect that there will be more opportunities for lending on the corporate front, and we will have to play that as it comes.
But what kind of numbers are you looking at in terms of credit growth per se and for FY15?
So, as far as credit growth is concerned, our credit growth will get constrained by what happens on the funding side. Axis has had one of the strongest CASA franchises in the banking space amongst the 10 large banks. I think we have one of the strongest franchises, and we would like to make sure that we keep investing in that franchise and growing in that franchise. But how well we do on CASA is what will determine how much we can do on the lending side. So, we are not saying that we are targeting a hard ratio of 40% or something like that, but I think it is just the relative outperformance of the sector on CASA what will determine our relative outperformance on the credit side. So, if CASA for the system grows at let us say 12% and we grow at 15-16%, so we grow 3-4% ahead of the system on CASA, then we think that will earn us the right to grow 3-4% higher on the credit side as well. So, if credit for the system grows at 14-15%, then we could grow 3-4% higher than that, provided we are growing higher on the CASA side as well.
Right, and asset quality, of course, has been something that we've been talking about for quite some time now. Do you think that it's going to slightly get better from FY15 onwards, and is that something that will probably become less of a concern for banks like you?
So, I think there are 2-3 things which impacted asset quality. One was the logjam on projects that we talked about. 2 was the logjam on the payment cycle, resulting in higher working capital requirements, and 3 was the deadly combination of low growth and high inflation, high interest costs. All of those 3 factors adversely impact asset quality for banks, and the hope is that all of those are going to start moving in the right direction. So, clearly I think that should help asset quality for banks, and we are very much part of the system, so it should help asset quality for Axis Bank as well.
And the other issue, of course, was restructuring. So,
Yeah.
is that something that we might see a lot more of in this year, or do you think that that also will start kind of petering down?
I think as projects come, some of the projects come in for implementation, some of those may need reschedulements or even restructuring. So, I would guess that for FY15, we are still going to see some more slippage and some more restructuring, and we would expect that to start to come off FY16 onwards. But we do think that from a credit cost perspective, credit costs have kind of peaked, and it shouldn't be worse than FY14 this year.
So, also we spoke a lot about the kind of capital demands and capital requirements for the sector, but for your bank as a whole, would you be looking at going ahead and raising capital? You did raise capital a couple of years ago, which has held you in good stead so far, but given the fact that there is still a lot of capital available overseas, is that something that you would be willing to tap?
So, we raised capital in the last year, in February 13 as far as I remember. And when we raised that capital, we raised enough capital to make sure that we did not need capital for at least 3 years. Last year there has not been much growth on the credit side. So, in fact our tier 1 ratio has improved since when we last raised capital. So, currently Aniruddha, we do not have any need to raise capital, and we would not want to unnecessarily go and raise capital if we do not see visibility on using that capital. We think we are one of the best positioned banks right now from a capital perspective. We are, even under Basel III, we have enough capital for the next 3 to 4 years. So, no, we are not intending to go to the markets for capital.
Right. So, a lot of your peer banks are listed overseas at the NYSE, and they have their ADRs going. Is that something that you would be open to the idea of? Are you looking at any kind of a overseas listing or an ADR?
We are always open to whatever makes sense for investors. So, we will evaluate that as we go along.
All right. So, another question which I want to ask you is in terms of organic expansion plans. There are a lot of small sized banks available, a lot of other financial ancillaries available at this point of time. May not be something that you are looking for, but is organic expansion is that something that's back on track for you all?
So, we think we've had a very good model of organic expansion as far as our core business is concerned, and that's worked well for us. It's kept us focused, it's kept us very productive. So, we would be open to look at inorganic expansion, but the acquisition target needs to make sense. So if it's a small bank which is going to add what we end up adding in the normal course in a year, then it may just end up being too much of a distraction. And unless it's bringing some core strategic capability that we do not have, I'm not sure whether inorganic acquisition would make a lot of sense for Axis Bank at this point.
Fair enough. Thank you so much, ma'am, for taking our time to speak to us again.
You're welcome.
Thank you once again.
Thank you.